Which Bitcoin mining stocks should you avoid? Which should you buy? JPMorgan tells you everything you need to know and a little bit that you don't about some of the biggest Bitcoin miners that are pivoting to AI and HPC. This is the Mining Pod brought to you by Cleanspark. We are going to be going over a recent research note from JPMorgan on some of the hottest Bitcoin mining stocks pivoting to AI and HPC. We're going to be giving you some of our takes and JPMorgan's takes on which ones are favorable and which ones you might want to downgrade a little bit. But first, a quick word from our sponsors, and don't forget to click below for the BitAxe giveaway. Guys, there is a serious problem right now in Bitcoin mining, and we need to talk about it. You need to pay attention to this. Bitcoin miners are identifying as AI companies, and people keep missectoring them because they say, well look, your infrastructure is clearly for Bitcoin mining. What do you want me to do about it? I'm going to tell you what you need to do. You need to call FBox, the leading digital infrastructure company with all-encompassing cooling solutions. FBox designs industry-leading air, hydro, and immersion cooling systems for Bitcoin mining and AI and HPC data centers. I want to highlight that. If you're a Bitcoin miner who needs to bridge the gap, if you're pivoting or doing hybrid operations, they can build cooling solutions and infrastructure for both your Bitcoin mining and your AI and HPC operations. And they have an in-house API that lets you monitor it from the web or on mobile. So go to www.fbox.tech/contact to learn how FBox can help you optimize your digital infrastructure today.
The future of Bitcoin and digital assets isn't being decided on the sidelines. It's being forged right here in Texas.
This October, the North American Blockchain Summit returns.
NABS is a leading industry summit for Bitcoin, digital assets, and emerging technologies.
Over 2 days, global leaders, industry experts, and innovators convene October 9th and 10th.
From groundbreaking regulation to the next generation of technology, the conversations here set the tone for the entire industry.
This is where investors, founders, executives, and public officials connect, not just to talk, but to build.
NABS 2025 will occur in Dallas, Texas, the hub of all things digital assets.
Everything's bigger in Texas, and Bitcoin's future is no exception.
If you're building on-chain, investing in future technologies, or shaping public policy, this is where you need to be.
The conversations that happen at NABS don't just stay in the room, they move the industry forward.
We are thrilled to welcome Governor Greg Abbott to both TexCap and to the NABS pre-event welcome reception.
Join us at the North American Blockchain Summit 2025, where the future starts.
October's in full swing, man. We've got Bitcoin ripping. We've got Bitcoin mining stocks and AI hybrids continuing to juice. A lot of deals have been signed over the last few weeks, and people are talking about it. And we've got this really good research report from Reggie at JPMorgan. And some people were pretty upset about the IREN price target, but we'll get into that in a minute. IREN is definitely top of mind for a lot of Bitcoin mining stock investors. It is on an absolute tear, as well as Bitcoin. I mean, look at that. We're at 100. Let's see, what's Cipher doing right now? Cipher's up at 15. I mean, all of these have just been too fast for them. Yeah, no, it's okay. He's Tommy Two Thumbs over there. But yeah, I mean, I think IREN really has been the kind of the belle of the ball so far. This as we enter Q4, you know, we're almost knocking on the door of $60. It's coming off of what was the June low? It was like 7 or 8. It's just been absolutely explosive. And to kind of set the stage for this, there have been a lot of question marks in terms of the future of IREN's AI strategy. They have been full bore into the cloud services model. They're building out this massive 2+ gigawatt facility, or these two campuses that will collectively make up 2+ gigawatts in Sweetwater, Texas, these Sweetwater facilities. And we're not sure whether or not they have a hyperscaler tenant lined up for those, but the stock is trading like it might. And that's one of the things that Reggie really zooms in on this research note about. There's also a lot of chirping on Twitter from analysts about this. But before we get into IREN, Will, I think, you know, you made a good point in the show notes before we started. Let's set the stage with like why these valuations are taking off right now and what the benchmark is in the market for these.
Even to backpedal a little more, just the JPMorgan report, I think is pretty nice. There's a lot of people who do these bank analyst notes. The JPMorgan one is typically one that people kind of look out for. Comes out every few months. They do updates on price targets, things like that, basically monthly, and then they do some other investment notes. So this one from lead analyst Reggie Smith has been pretty helpful, and we've had him on the show at least twice in the past. So if you're interested to go back and look at those and kind of get the history of how they think about things. For this research report, in general, the biggest trend is re-rating a few Bitcoin miners based on AI HPC execution and expectation. For the execution side, that would be your IRENs, your Ciphers, your TeraWulfs. I don't believe TeraWulf is actually covered by them, but IREN certainly is, in TeraWulf or Cipher is, and then also Core Scientific. Now, for the re-rating, those with expectations, that'd be more on the Riot, the Cleansparks, and a few other names out there. So this report kind of dives into all those things. For our purposes here on the show, I think the main thing we want to go through is, one, what does the report say? And then two, what is the logic behind it? Even if you disagree with the math, we can go through the math and sort of show that. And then you, Colin, did some legwork to kind of look at some of the other price targets, other numbers that are out there, whether that be Twitter plebs that really are loving a stock and did their own math, or other bank analysts out there that we're going to use some of their information. If you're curious about this, we actually cover and typically republish these reports, or the summaries of them, I should say, on blockspace.media, or you can go to our Telegram channel and get those sooner. So remind me what your question was again before we jump into this, though.
I mean, I think, well, we'll jump into it in the report, but I think that the deal that really sets the standard for all of these is a Core Scientific.
Oh, yeah, the deal. Core. Yeah.
Yeah. And like, that's kind of, a little play on words. That is the cornerstone of all of these AI pivots, right? Like, Core Scientific was really the first miner to really go full bore into this. And now they're seeing the fruits of it, or not. We'll see if the deal goes through. But that has created expectations for what one of these Bitcoin mining pivots to AI could look like, and what the valuations could realistically be. And so once we get to that talking point, I think it'll be interesting. Well, it raises questions about, like, what does the shareholder vote mean on October 30th? That failing or succeeding, how does that affect these valuations? But we'll get to that as we go through the note.
Yeah, that's a good point. So for those without context, maybe you're listening on CoinDesk or just pick this up on Yahoo and you're curious what Colin's referring to there. CoreWeave and Core Scientific have been doing a little bit of dance since the summer months, where they entered into an LOI for an all-stock merger with no collar. Basically, we give you a percentage of CoreWeave in exchange for them taking over Core Scientific entirely. It's about 10% of CoreWeave. We've been waiting on that since the Q4 vote was just assigned to October 30th or 31st. And that maybe could change some re-ratings a little bit. I personally think a lot of stuff is baked already, but to back the truck even further, the real thing that set like the benchmark was the initial CoreWeave Core Scientific deals back in like 2023. And that was basically just a co-location agreement for CoreWeave to come in, drop some GPUs in Core Scientific facilities. Core Scientific did the retrofit, but CoreWeave picked up a bill, and then they've been deploying those GPUs. And there's like a really good cash flow numbers you get from that, right? Where it's like a few billion, like 10 billion or something like that over a certain amount of years. Most of the deals since then have sort of mirrored that, right? Where we have the TeraWulf ones with FluidStack and Google being the backstopper. Cipher just executed similar run with FluidStack and Google being the backstopper again. IREN's been the only sort of standout from that crowd, where they have not had a major deal signed, but instead they've gone to the private market, got capital from either ATMs, convertible notes, or just their share price going up in general, and been able to continue to build out their multiple campuses, purchase GPUs, and now they're monetizing those, or attempting to monetize those. We haven't seen numbers that reflect that yet through a few different generalized cloud marketplaces. Eventually, they want to become like a CoreWeave or like a Nebius or someone else like there. So I think that is some good background. I'm glad you brought it up for this JPMorgan report, because all these Bitcoin miners, yes, they're similar. They have megawatts. They're typically in North America. They've pursued similar strategies to date, but we're starting to see the different strategies differentiate. IREN on one side with the cloud marketplace, maybe like your Cleanspark and Mara, which have been more pure play miner on the other, and then your Riot and a few others in between that have signed a deal or have not signed a deal, like Cipher, Riot. Cipher signed a deal, Riot has not, but still looking for the same strategy. I'll let you take it to the next place, though, after I went through all that.
Well, yeah, I think that's just like the place to start. And I think that you're right in pointing out that the original blueprint was the first CoreWeave deal that was signed with Core Scientific. And then we've seen iterations on similar models, like you mentioned with TeraWulf and Cipher, with Google backstopping some of this revenue. Some of those were structured pretty creatively. But I think the place to start, going back to the bell of the ball, is we can just start with IREN here in terms of what JPMorgan is saying for IREN's upside for the rest of the year. And I think you have some good comments here too from Reggie himself in terms of these are not hard price targets. These are ranges, right? And so Reggie got a lot of backlash for having a lower target than some of the IREN cheerleaders on Twitter would have wanted. But at the end of the day, these are investment banks. They have to make conservative calls, and these are estimates. They're not, no one can divine the future. If we could, we'd all be rich and we wouldn't be podcasting. So yeah, let's just start with JPMorgan's price targets. And Will, you have some good color as to like why these are so much lower than what we're actually seeing. And this is part of the reason why Reggie got some backlash for this, but there's a reason for this. These analysts play conservatively and they provide ranges, not set numbers. But so quoting from the report, JPMorgan says specifically, our IREN price target moves to 24 from 16. Our Cipher price target moves to 12 from 6. And our Riot price target moves from 19 from 45. And they say we are trimming our Cleanspark and Mara price targets on weakening mining economics. Our Cleanspark price target moves to 14 from 15. And our Mara price target moves to 20 from 22. So, Will, can you explain why these are lower than what we're already seeing? Because Cipher is already more than double what this price target is. Or sorry, excuse me, IREN's already double what this price target is.
Yeah, so these price targets, when you first look at them, like they're often just a lot different than what the market reality looks like. And there's a lot of reasons for that. Maybe it's just hope and enthusiasm. The animal spirits in the market might be one reason for that. There's also the fact that these price targets live in a moment in time, right? Like this report was created and put out last month, and a lot has shifted since then. We've had the macro environment shift. Bitcoin's gone up in price, and there's other things. So like all these price targets do live in a moment in time. The investment bankers typically update these maybe once a month, depends on the stock, and they typically give a forward-looking year-end target date. So for 2020, we had the December 2025 ones, and then they just update theirs to December 2026 for this report. And they'll periodically kind of change those depending on new information, right? Basically, stock price is just kind of baking in future revenue, and that's what you're getting with these price targets. So when we look through this entire report, which we're going to go through here kind of systematically, you're essentially looking at what is the business valued on all its components and parts based on a few different ways analysts look at things. So there's enterprise value, divided by or enterprise value and EBITDA. As EBITDA, look at it like adjusted EBITDA. There's discounted cash flow, and for actual more CFAs than us, we're not. We're just you're off the street podcasters. You're going to take these things, put them into the model, take all the numbers, metrics, put it into the model, and it's going to spit out a price target. And so that's what you get with this. You're also going to get, based on the assumptions that you bake into a price target or you bake into a company, a range. And I think that's probably the most helpful thing here when you're looking at some of these companies, because yes, if you're going to take the value of a company based on all its parts and assign, adjusted EBITDA or whatever metric you want, and then a multiple on top of it compared to peers in the market, and then divide it by the amount of shares that are out there, you're going to get to a price target. Like, it's pretty basic math. It's pretty simple. There's nothing too crazy about that. But that number could be wrong very quickly, like we've seen with a lot of these stocks where they'll just shoot past it really fast, or they'll go under it, right? It'll be like too bullish. And that's why you need the range, because the range is going to give you all the different considerations that go into it. So for example, for the IREN one, which we'll get into for a second, there's a lot of considerations around like, does the IREN team have a deal baked into Sweetwater or not? And also, what is like the upper bounded side of being able to sign a co-location agreement? So for Sweetwater, it's like 1.2 gigawatts. The largest deal that we've seen so far for a co-location is this Core Scientific CoreWeave deal, which was 800 megawatts. So, that's 25% more or 20% more, whatever the number is, larger than we've seen to date. And so you have to take some execution probability, or there's some execution risk, and you have to take a probability based on that. And so you're going to give yourself a bounded range. And that's one thing that's noted in this report. They give Riot the highest upside, and they adjust a new price target for it. And that's because looking on their price target and then looking at their range, they only baked about 38% of the upside into Riot's current market cap as of time of publication. And so they saw more upside for Riot at that time. versus IREN, which had already baked in about 52% of their supposed upside at that time. Now, since this report came out, those numbers are all over the place. So these price targets don't really matter at this point. What really matters is the enterprise value, the adjusted EBITDA, the discount cash flows, and then assigning the multiples to those things. So I think when we go through this podcast, like that's what we want to focus on is like, what are the values we're seeing in the market right now for peers, maybe even outside of Bitcoin mining, and then approximating that against the potential megawatts that all these companies have.
We are Cleanspark, America's Bitcoin miner, a publicly traded company with the largest operating hash rate, powered entirely by self-operated infrastructure across 4 states. This is our proof of work. We are setting the standard for what's next. Learn more about the intersection of energy and Bitcoin at cleanspark.com.
Which one do you want to start with?
I think we should start with IREN. And I think we should zoom in on the Sweetwater thing and like the revenue potential per megawatt for co-location versus cloud. So this was, I think, one of the more important things to ground the conversation at this point in the AI race for the Bitcoin miners, because as we said on the pod before, IREN is taking a completely different approach, at least for its nascent AI business. It is spinning up GPUs on its sites, and it is running cloud out of its own, self-owned data centers. So all the other ones like Core Scientific, Cipher, TeraWulf, they've gone the other route. They're doing PowerShells. They're providing infrastructure and doing co-location for another company's GPUs. That could totally change, like you said, if Sweetwater ends up getting a 1 gigawatt tenant. And that's a huge deal if that ends up happening. Then IREN really could be running away with away from the pack here, because it has both in its clause. But right now, JPMorgan in the report, they reckon that like co-location in terms of gross revenue per megawatt comes in at about 3.7 to 8.6 million per megawatt, versus 5.3 million per megawatt for IREN's co-location. So it's like if you average out, or for IREN's cloud business, if you average out the co-location revenue per megawatt, you're almost there. But the thing that JPMorgan also points out is that you have a refresh cycle for all that hardware, probably about 3 to 5 year, 4 year depreciation cycle where you want to get new stuff in. Obviously, that's extremely CapEx intensive. And that's one of the reasons why some of these other miners have decided not to go that route. They know that game from Bitcoin mining. It's incredibly brutal to stay ahead of the ASIC hardware cycle, and same with GPUs. And it's incredibly cost intensive. And they would rather just have, sell the picks and shovels, so to speak, or rather sell the infrastructure than have to deal with all of that. And I think that really is the biggest question mark going forward in terms of we see kind of these diverging business strategies. And just one last note on the valuation for IREN, just to highlight it. JPMorgan does say that like when they put this out, and that was assuming the $24 price target. So it's certainly true now. They say, quote, our valuation, Reggie writes here, our valuation work suggests that market could be pricing in 50 megawatts of cloud computer Horizon 1 and nearly 1,400 gross megawatts of co-location at its underdeveloped Sweetwater site, which would represent the largest co-location agreement on record in addition to its 50 exahash Bitcoin mining operation. So IREN's trading at a crazy multiple, considering that hasn't happened yet. And I think it's also, that's been some of the criticism from some of the retail traders on the other side of the bet, saying we haven't seen anything from Sweetwater yet. There's also the argument to be made, going back to what I was saying earlier, maybe cloud services is overblown versus an infrastructure play, especially considering you're going up against hyperscalers whose access and cost of capital is probably much lower than yours.
Yeah, a few points here. So on the IREN side of things, right, most of the revenue that we still see to date derives from Bitcoin mining. It's fine. They're 96%. They're world-class executor on Bitcoin mining. Like that's just factually true. They've been on top of the charts for efficiency, deployment speed, exahash for months now, about a year. So we have to hand it to them on the execution side, and the fact that the play is for them and for others, use Bitcoin mining to get to that next leg, which is the more lucrative on both a cash flow side and a multiple side of AI HPC. and that infra play. Now, what didn't really develop and we expected for a while was signing a co-location deal or signing some sort of JV. They talked about that pretty relentlessly last year about how deals were pretty close. Nothing really happened. And I think they pivoted and or were already kind of working in the background to become like this neo cloud where they become the full stack. Anyone can come to them and just use their megawatts. Now for the Sweetwater deals, right? I think it's like close to 2 gigawatts total between the Sweetwater 1 and 2. It's a very large campus.
The total capacity is 2 gigawatts between both campuses,
which is crazy. And the first one should be available April 2026, at least for the interconnect deal to be done. Like who knows when things get on the rack and all that. Essentially what has been baked, what we know for like the revenue size, that 50 megawatts of critical IT has been moving pretty quickly for the Horizon 1 campus, I believe. And then you have the Bitcoin mining, right? So like, are we doing a multiple for that Bitcoin mining in that Horizon site with the 50 megawatts? Or are we doing it for all of that? And I think with the size of the deals and the money floating around out there, for like the AMD deal we saw this morning with OpenAI, or the NVIDIA backstop of OpenAI, or the CoreWeave and NVIDIA deal, I think there's a lot of speculation that hot ball of money is just going to keep flowing into IREN. And that is a speculative trade, but it's a trade so far that has proven to be pretty solid, right? So if that's able to execute and occur, then the victors go to the laurels. So good for them. On the flip side, the downside of it is like, hey, all these other companies, Galaxy, CoreWeave, Core Scientific, TeraWulf, Cipher, they've actually closed deals. And we've kind of seen like what the upper bound is for those deals. And now they're kind of chugging along, executing on top of those. And we kind of know where those are. So it's been particularly interesting that IREN's been running, even though it doesn't have like a quote, quote deal signed. We can talk more about the numbers if that's interesting to you.
I just want to highlight a point really quickly that you just made that you're setting up massive expectations for yourself in IREN's case, right? And per JPMorgan's note, it's like the way that it's trading, you do need to get above that gigawatt for a deal for a tenant for this to make sense. And if they don't do that, what ends up happening to the stock? The other thing I wanted to highlight too, considering that they're going for both cloud and co-location plays, I would love to talk to an analyst like Reggie, maybe get Penny on and just probe their mind for like what that does in terms of muddying your valuations or adding too much noise, right? Because you're trying to model it based on three different business models, including Bitcoin mining. All those aren't really factored in these valuations, right? They have nothing to do with the multiple, but you're trying to figure out what the multiples should be for these two completely different business models within the AI realm. So all that being said, I feel like you put it right. Like there's just this hot ball of money running around. It's like raining money and everyone just assumes that their favorite Bitcoin miner is going to continue to pick up checks.
So the last thing I want to bring up with IREN is just talking about how we're kind of modeling out the value of their GPU fleet. So reading from the JPMorgan report, IREN is in the process of expanding its GPU fleet from about 2,000 hoppers today, about 30 million annual revenue, to 23,000 NVIDIA GPUs, including about 19,100 Blackwells, capable of generating over 500 million in annual revenue by Q1 2026, implying about $2.40 per GPU hour, according to management's forecast. IREN is spending about $675 million to acquire the latest batch of GPUs, about 12,400, or about $5,400 or $54,400 per GPU to hit that Q1 target. JPMorgan estimates those 23,300 GPUs will consume a bit over 50 megawatts of critical IT. Again, that's about Horizon 1, so that's where all those GPUs are expected to go to. Last thing, going to quote here, when thinking about valuation, we also refer to publicly traded cloud service peers, including CoreWeave and Nibius. CoreWeave is CRWV and Nibius is MBIS. CoreWeave and Nibius trade about 6x and a 16x 2-year forward street adjusted EBITDA. Our discounted cash flow implies a 3x multiple to IREN's cloud services adjusted operating profit estimate. That said, per NVIDIA Blackwell specs, we think some cloud operators may deploy three times the GPUs per megawatt than what's implied in IREN's guidance, or about 450 GPUs per megawatt, which would increase our equity NPV to about over $15 million per megawatt. Long story short, there is a difference between how IREN is being judged in this report versus CoreWeave and Nibius, which are sort of like the counterparts IREN is trying to compare itself against. And I wanted to bring that up for basically two reasons. One, this report was getting some vitriol online, specifically because of that multiple. And I think it's fair to say that, you know, it got that multiple because CoreWeave has the execution side of its business. We noted on the podcast, like the revenue for CoreWeave is over $1 billion per quarter, whereas this new round of upgrades is going to get IREN to that 500 million ARR target for Q1 2026. So like there's a classification difference between the two at this point. And so that's why they're not getting necessarily the multiple. And then on top of it, it's also like the risk of executing or getting a deal. And so for JPMorgan, my understanding is they adjusted EBITDA because they have an operating business, whereas IREN is growing and scaling into it. And that's why they used a lower multiple with a discounted cash flow. And those sort of numbers or metrics allow you to kind of look at the two things differently. One's operating business, one is growing into an operating business. Both are in great spots. Like, you know, I'd hate to be at either company, right? They're making so much money. But for those online who are upset about these things, you do have to think about IREN is still in that execution phase. Now, there's tons of execution risks for CoreWeave, but they're different, right? They're more around like, can CoreWeave continue to execute for all its signed contracts, and can it diversify its revenue, right? That was like the big thing when we talked about CoreWeave, is like, can they diversify away from just Microsoft? Versus IREN is like, okay, are they going to get someone to like actually sign with them a co-location deal or sign a deal for the critical IT loads and you be using it? Like, is a Microsoft going to sign with IREN? So I wanted to note that. That's probably my last thing on IREN.
Yeah, going back to multiples really quickly, I have some EVs for all of them and their EV and revenue ratios. This is according to Yahoo Finance. Just quick disclosure. So like Yahoo Finance, when they do EV values, they calculate it in a traditional way. Sometimes people like to include Bitcoin holdings into EV values. But they're not going to do that. They don't include Bitcoin as like a cash position thing. So some analysts like to do that for Bitcoin miners. I'm not doing that here. I didn't just pluck these from the SEC filings, but I think they're close enough to illustrate the point, which is right now, IREN is trading at an EV for annualized revenue according to Q2 of 12.9 versus Cipher at 31.9, Wolf at 27.1, Riot at 12.5, Cores at 19.5. So what's really interesting about that to me is like you can see with Cipher and Wolf, clearly the market is saying that they favor the co-location deals. And then you can also see why some of the IREN bulls are frustrated with these price targets and some of the multiples because they're trading at a much lower multiple compared to some of their peers. I think that's for what you just said, though. We have not had any clear indication about a deal for Sweetwater. And right now, the market is saying the GPU as a service thing is cool. Cloud as a service is cool. We're not sure that the upside is as favorable as the co-location side of things. The other interesting tidbit from this for me is the market is treating IREN and Riot as though they have the same upside right now. And JPMorgan in this note kind of says that, you know, they see a little more upside for Riot because there hasn't been the same hype and expectation. All that being said, I think that Riot and IREN trading with similar expectations makes sense considering there are big expectations for some of these massive sites they have. It's just a question of, do they actually have the deals lined up? And I think that over the next quarter and into the Q1 2026, I wouldn't be surprised if you see, if you saw some announcements. Because if you saw like Cipher and Wolf too, a lot of these stocks will run up in anticipation of these things because people know what's going to happen. I'm not saying that people are insider trading, but word gets around. So I'd be shocked if we didn't hear something from IREN, but not investment advice. Don't go bet the farm.
One last thing before we kind of wrap up here, I want to talk about the Bitcoin mining side of things. So we'd spent a lot of time on IREN for good reason, right? Like they're doing pretty well. People want to talk about them. And then the JPMorgan report really sort of stood out for that reason. I think if you are interested in this and you want to learn more, give us an email at hello@blockspace.media. We're happy to talk to you a little bit more about this. Or if you're an analyst out there, we actually DM a lot of the bank analysts out there about these kind of things. So interested to talk more. A lot of these price targets, again, just come down to how many megawatts do you have? How many megawatts do you expect to have for a co-location deal or for building out your own AI HPC? Is it going to be critical IT? Is it just going to be like regular IT? Is it going to be Bitcoin mining? And then applying a number to that and then giving a range on like the upside or downside. So that's, it's just math at the end of the day. And then people can argue online about if they like the math or not. For the Bitcoin mining side of things, the note that was interesting to me was the $1.5 million to $3.5 million megawatt on an EV basis that JPMorgan assigns to them. That's before considering cash and the HODL balances. And this also, this range basically bakes in like how efficient is your fleet, and like how old is it, all that kind of stuff. Mara is on the low side. They have a less efficient fleet and their power costs are a little bit higher. That's some of the problems from the legacy model they have, where they were asset light and they had a bunch of deals with not great hosting contracts compared to some peers, and they've had to work their way out of that. And then also it doesn't seem like they've done a fleet refresh. And I think that's also part of their strategy of working with IREN, where they've been trying to vertically integrate. And they've also decided to take some of the route of using cheaper energy at like that wind farm that they own and plugging in older machines there. So that's also going to give you like a lower value per megawatt. And then on the flip side, you have IREN, which again has some of the best megawatts out there for Bitcoin mining. You can just look at that month over month. Like they mine some of the most Bitcoin, they mine at some of the cheapest cost out there. And they have great fleet efficiency across the board. So there's not too much on the mining side besides that. It's obviously a lot easier to look at the math for the Bitcoin mining side of things. And that's part of my frustration with this whole space moving over to AI HPC is like the math starts to get a little bit more mathy as opposed to what it used to be. So it's a bummer for you and I.
Well, yeah. And it's also, there are unknowns that still need to be worked out, right? I mean, even the NeoCloud model is so new. It's when investors and analysts are trying to value these companies, they are kind of in a new digital Wild West, like what they were with Bitcoin mining a few years ago. Like we had hash price and stuff. Now we're trying to figure out like, prices of compute, price per megawatt for different cloud business models. So yeah, definitely frustrating, but Bitcoin mining is not going away, but definitely the air is sucked out of the room right now. I'm kind of looking forward to maybe a day when we can go back to covering some miners a little bit more for just mining, right? And not the AI stuff. Although being at the intersection of it is really cool. Who would have thought that Bitcoin miners building megalithic mines in the middle of nowhere in Texas would end up translating to them having huge bargaining chips during the AI revolution. So, hey,
I will say that Bitcoin price is up. Hash price might be eternally down, but hash rate continues to go up. So there could be more there. Let's close out there. Thank you for checking out the Mining Pod. As always, go check out all our other content, blockspace.media, to get a lot of these headlines, banknotes, things like that, if you're interested in the space. And then give us a DM or an email, hello@blockspace.media. Colin, talk to you later.
And if you were at NABS, come say hi. We'll have a booth.
True. NABS. Yeah. This week, Tuesday through Friday. So it's a good note. Way to plug that. Yes, sir. Come say hello. We'll have a booth. We'll be doing some recordings and shaking some hands. So we'll see y'all there.